What's going on, YouTube? So you sign up for a Robinhood account, you get a free share of stock, and is that free share of stock any good, right? Should you sell it? Should you buy more? Should you just hold on to it? That's something I'm going to talk about a little bit today. And what really sparked this question was over a year ago, I referred someone to Robinhood and I got a share of Groupon, right? Which used to be very popular, but it's something that you don't give out anymore. And when I got it, the share was worth about $3 a share. And yet, recently the price dropped significantly. Now it is trading at 92 cents a share. Now Robinhood doesn't give this one out anymore because they have a minimum stock price that they give out of $2.50. But that kind of got me thinking, are the stocks actually any good? Because I also referred someone a while before that and I got SiriusXM, which has performed quite a bit better. So what I did, I went on YouTube, I watched people open up over 100 free shares of stocks from Robinhood to get a idea of what people get, and I kind of compiled a list, and I want to talk about a few that I saw the most frequently. Now, this is not a comprehensive list, but hopefully it should give you an idea of some things to just kind of think about a little bit. Also, I want to note that I'm not including the ones that you have a 1 in 50 chance of getting, or the stocks that you have a 1 in 200 chance of getting. Just because those tend to be higher valued stocks and the odds are low, so the odds are really low that you're going to get them, so which is why I'm not focusing on them as much. So the first stock is SiriusXM. Now they have been hit quite a bit by the coronavirus situation, as every stock has, and they're trading at $5.25 a share as of today. And as a whole, personally, I would say it's a good one to hold on to. Not buy anymore, not sell anymore, just see what it does going forward, put it on your watch list, but hold on to it. And the reason why I say this is because, SiriusXM is a company that allows you to stream satellite radio in your car. And with that being said, though, it's a great service. A lot of people like it, but there is also a lot of competition, right? Here you can see the cheapest offer is $11 a month. There's competition like Spotify, for example, which is $10 a month for their premium option. Also, SiriusXM doesn't have any free versions. Spotify does. But with that being said, though, they have been increasing their revenue. They're increasing their net income over the past few years. Where, as you can see, as of 2018, net income was $914 million. It's down from the year before that, but as a whole, it's up over the past 3 years. And the revenue has been going steadily up as a whole, which is something that, it's a very, very rough measure of their performance, but a lot of things go into their net income, which I feel like it's something important to consider. That I like with SiriusXM is that they do pay dividend. It's only 1.31 cents per share a quarter, but I feel that the fact that they pay a dividend is a sign of their financial strength. With that being said, this is an extremely high-level overview of the company. I didn't do any in-depth analysis at all, but this is just looking from a high-level overview. This is my opinion. The next stock that a lot of people got was Zynga. So Zynga is a mobile gaming company that makes a lot of very, very popular games. So here's a website right here. They've made Game of Thrones, Slots Casino, Words with Friends, Zynga Poker, and some other games, right? They are trading at $7.56 a share, and they have actually been performing fairly well over the past year, largely in part, I feel, because with the coronavirus situation, people are not getting out of their houses as much, and they have a lot more time to do things like play games that are made by Zynga, which has been helping them out as a whole. Personally, I like Zynga. The mobile game market is a very, very large one. About 33% of all apps that are downloaded are mobile games. There's millions and millions of players that play them every single year, and games can last a very long time. So, for example, Zynga Poker is about a 10-year-old game, and yet people still play it quite often. Also, their net income has been going up quite substantially. As you can see, it's from as you can see right here, where last year these numbers are in thousands, not millions, but they had 4.41 almost 42 million in net income as of last year, but they don't pay any dividends. But with that being said, though, not paying any dividends, doesn't necessarily, in my opinion, doesn't mean that they are lacking financial strength, because not paying a dividend can also mean that they're getting whatever money that they get, and they're applying it back to the company. And this is going to be especially evidenced by their by their increasing substantially over the past 3 years. Also, you can see right here, the research and development expenses has been increasing drastically over the past 3 years as well, where, as you can see, it was 505.9 million in 2019, 270.3 mil in 2018, and 256 mil in 2017, which is a good thing, because this research and development cost is going to help them make more games, get more players, and grow in the long term. So personally, I like Zynga, and I would personally buy a little bit more of it, in my opinion. The third stock that I saw a lot of people get was GameStop. So GameStop is a company that is known for selling video games. They first got their start in the late 80s, early 90s by selling various platforms and video games. And as you can see, though, they haven't been performing very well, right? A year ago, they were at almost $9 a share, and it's especially drastic when you look at the 5-year chart. Right, 5 years ago, they're at almost $40 a share. And personally, GameStop is a company that I would sell if I got a share of it. The reason why is because, at their core, they're just not a very strong company. GameStop is very, very, very focused on selling physical games. And yet we're seeing a rise of online games, for example, like Zynga, right? They have a bunch of games on people's smartphones, which people are playing instead of consoles. Also, we're starting to see a rise and increase in games that are being streamed, and an increase in games that are being just downloaded as opposed to bought physically. But the biggest thing is that most of GameStop's revenue comes from used games, right? GameStop earns a much higher margin from used games than they do new games, right? But if people aren't buying new games as much, there is not as many used games for them to buy, which is going to hurt their income going forward. And this is something that has really had a negative impact on the stock price. I mean, yes, they could change, but the fact is they haven't been changing, which is reasons why I would personally sell them. But an interesting thing to note, however, is that they have actually gone up. They have actually spiked up quite a bit recently. Here you can see April 3rd, $2.80 a share. And as of a few days ago, it was almost $6 a share. Why was this? Well, one of the guys that was originally known for the Big Short bought shares of GameStop, which investors think is a positive thing, because that could potentially mean that he sees something in the company that a lot of people don't really see. However, looking into this a little bit further, he was actually buying this in the hopes of being able to be an influence on the management to improve their operations. So with that being said, yes, he bought some, but I feel like he bought some in the hopes that he could influence better operations, maybe improve the fundamentals a little bit. And until he does that, I personally wouldn't buy any more shares of GameStop. And this is especially seen in their performance recently, right? Financially, here you can see there's been a drastic drop in their revenue, right? It went from 8 billion in 2018 to 6 billion in 2019, which is a very drastic drop. But the biggest thing for me personally is their net losses, right? A few years ago they actually were earning a profit, but in the past couple years they have had massive net losses, which is something that I think is a bad thing. And also, they used to pay 38 cents per share dividends, but that's something that they don't pay anymore. But however, that being said, though, if Michael Burry can really just go through and kind of change operations, change their focus, maybe get GameStop to just be a more focused company as a whole, and focus more on maybe digital products, maybe more online platforms, then I feel that there could be potential in the company. But until that happens, I personally wouldn't buy anymore. With that being said, this is a very high level overview of these companies. A much more in-depth analysis, it can be very, very beneficial in getting a much more comprehensive understanding. I just wanted to, with that being said, this is just like a very high level overview of these companies. and a much more in-depth analysis of these companies could be very, very, very beneficial in kind of getting much more comprehensive of their operations and their prospects. And also, keep in mind too, this is my opinion, right? I'm not an expert. I'm just some college student, giving my opinion on a couple of stocks. So, but that being said, I hope that this gives you a few things to think about, a couple of things to look at when making some decisions. And as a plug, of course, I'm sure you're expecting this already, but Robinhood referral link in the description below. I mean, yes, the free stock you get might not be good, might not be bad, but regardless, free money and free stocks is always good because you can sell it and put it in your bank account or put it into something that you just like a little bit better. Plus, there's even have a slight chance of getting a share of Facebook, which is like trading at $177 right now. So, link in the description below. Comment, like, ask any questions. Thank you. Subscribe. Have a great day.